Okay, let's talk here about how we can determine the cost of capital. What is the cost of capital? Quite frankly, it is just the cost of financing. As we know, how it fits into our equation, right? It is right here. It is the required return to understand how we measure the value of operations of the company. So that number, the weighted average cost of capital, has two primary components: cost of debt, cost of equity. So, what are the things that influence this? Outside the company, we have influences from the market interest rates, the supply and demand of money, but we also have the market risk aversion. How are investors looking at the riskiness of investing in general? What are their thoughts? What are their preferences? And of course, inside the company, we have the aspects more of what is the company's debt equity mix and what is the company's business risk. All of these things have influence then on the cost of financing. So the three primary sources that we have is long-term debt. Some companies also use what's referred to as permanent short-term debt. There's some temporary short-term debt also. So the temporary aspect is typically not considered part of this capital structure. We're looking at long-term debt. So how we incorporate this permanent short-term debt, that can be more company-specific kinds of choices. When you think of common equity, though, we also have to think of this financing could be internal from the profits of the company, or it could be external from the sale of common stock. So essentially, we're looking at four sources of financing long term for the company. Now, for most companies, a vast majority of the companies don't have preferred stock. So for many companies, it's just a choice of, do we use long-term debt or do we use investments from our owners to finance operations of the company. So again, these are sources of finance from investors. We don't look at the short-term aspects. They're not really sources of financing that come from investors, so they're not included. When we look at cash flows of a company, of course, we do have some adjustments that we have to make, but we don't have to make those types of adjustments in cash flows when we're talking about the actual cost of capital. So in essence, again, all we're talking about is the long-term debt that we're looking for in the company and the costs that are associated with that. So there is a before tax and an after tax capital cost. If the source of financing is influenced by taxes, then we are going to have to make an adjustment. Now, it's very simple. Debt is influenced by taxes. Equity is not. So we will have to adjust the cost of debt because we're going to have a before tax cost of debt and an after tax cost of debt. Now, when you think about the other, like for instance, common stock, there's a before tax cost of common stock, but that is exactly equal to the after tax cost of common stock because there's no influence, so there's no change. So how can we find or look at these costs? We can look at historical costs or new costs. The cost of capital is usually looked at to make decisions moving forward. So we need to focus on marginal costs. What are the costs of new debt, not what is the cost of old debt. So we're kind of narrowing this cost of debt thing down to, we want to look at what is it going to cost the company to gather new funds to buy new projects in the future. So there are a couple of methods. The first thing we could do is we could ask an investment banker what the coupon rate would be on new debt. That's one way. Another way we could do this is we could find the bond rating for companies that use the yield of other, like on other debt. So in other words, if we have a triple A rated debt and we're going to issue triple A rated debt, whatever companies are that are already getting triple A rated debt financed, then we could use that methodology. In addition, we could also find the yield on the company's current debt if it has any. So there are several ways we can find this cost of debt. So let's look at the last part, the yield aspect. So this is the weighted average cost of capital workbook, the WACC worksheet. And we're going to start working with debt. So what do we need to know? The same things we needed to know with respect to finding the value of debt and the yield to maturity. That's the number we need here. So we need to know the coupon, in this case 12%, 15-year debt. Current price is $11.53. The tax rate is 40%, and the par value is $1,000. Now, if you note here, we have a space for flotation cost. If the cost of financing this debt is very expensive, we may want to incorporate that in here. So if, for instance, we talked to our investment bankers and they said, look, it's going to cost you $30 a bond. So we would put $30 here for flotation costs. And of course, that additional cost would be incorporated into the cost of financing. So the cost of debt would go up. In this case, we see that the cost of debt before tax is 10.19%. When you apply the tax rate, 1 minus T, the after-tax cost of debt is 6.12%. So in this case, for this debt, if you think about the actual dollars spent out, the after-tax cost, 6.12%. And of course, here's the math of how that works. 10.19 is the before tax cost. The 6.12% is the after tax. They also mention here flotation costs are small, so we can ignore them. Now, one of the things that is in reality current day type of information is that 40% is an extremely high number for taxes, corporate taxes. Currently, the maximum corporate tax rate is in the ballpark of around 20%. That may change soon. We don't know. But right now, it's half of what it is now. So if it's half of what it is now, then the after-tax cost increases because the government is substituting less. Or if they increase it, it will actually 20%. I'm sorry. It should be around 8% right now. But of course, if they change the tax from 20% to 30%, then obviously the after-tax cost is going to go down because the government would be subsidizing more of that cost. So as the tax rate changes, the after-tax cost obviously changes for the company. So now let's look at preferred stock. preferred stock, we have $116.95 is the cost. 10% is the coupon. Par value is 100, and the flotation cost is 5%. So here we have the dividend. The par value is $100, and the coupon is 10% of that. So the dividend is $10. Here's our price. And in this case, we have that the flotation cost is 5%. It's 5% of par value. Or, again, you'll be told 5% of what, right? So it's either 5% of 100, which it is in this case. You could also be told it's 5% of the market price. You could also be told that it's $5. Whatever it is, you want to input it here, and you can see here the sign. You want to put it in here as dollars. So what is the after tax or the before tax cost of preferred stock? 8.93%. And of course, the after tax is equal to the before tax because there's no tax influence on issuing dividends for preferred stock. Again, dividends, just like common stock dividends, are not taxable. They're not deductible from taxes. When we think about stocks, typically flotation costs are a little bit more expensive for stocks than they are for dividends. So we may want to incorporate flotation costs. Again, if they're real small, we don't need to worry about it all that much. And again, here we talk about, again, I just mentioned it here on this slide. They're not deductibles, right? So again, there's no tax adjustment. So the after-tax cost is exactly equal to the before-tax cost for preferred stock. Now, one of the things that you might have noticed, or maybe you didn't notice, is the relationship between the before-tax cost of preferred and the before-tax cost of debt. You can see that the cost of preferred is less. Why is it less? Typically, common stock is, or we think of stocks in general as being more risky than debt, right? But the company's not required to make this preferred dividend. They can skip it if they want, right? So if they want to pay the preferred dividend, right? Again, most companies want to pay it because if they don't, they can't pay a common dividend. It's difficult to raise the additional funds. And again, preferred stockholders might gain control of the company if they don't make payments, right? So in this case, we're saying that in general, the preferred stock is probably less risky on the face of things than what debt is. So corporations own most of the preferred stock. About 70% of the dividends are not taxable to corporations. They get, in quotes, a little benefit for this. So not a lot of investors own preferred stock. Again, so preferred is often has a lower before-tax yield than the before-tax yield on debt. After-tax yield, though, is different, right? The after-tax cost of debt is less, usually. Again, the numbers obviously will make that more true, I guess. But with the huge deduction on taxes, the after-tax cost of debt drops substantially. So again, we have these two sources of financing, debt and preferred stock. We'll move on to the next sources in the next video. Look forward to seeing you soon.